Ladies and gentlemen, good day and welcome to Astec LifeSciences Limited Q4 FY22 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniruddha Joshi from ICICI Securities. Thank you, and over to you, Mr. Joshi.
Yeah, thanks, Nirav. On behalf of ICICI Securities, we welcome you to Q4 FY22 results conference call of Astec LifeSciences Limited, a subsidiary of Godrej Agrovet. Now I hand over the call to Mr. Aditya Desai, Head of Investor Relations from Godrej Agrovet as well as Astec. Thanks and over to you, sir.
Thanks, Aniruddha. Good afternoon, everyone, and thank you for joining us on the earnings call of Astec LifeSciences Limited for Q4 FY22 and full year ended 22. We have with us today Mr. Nadir Godrej, Chairman of Godrej Agrovet Limited and Astec LifeSciences Limited. From Godrej Agrovet Limited, we have Mr. Balram Yadav, Managing Director, Mr. S. Varadaraj, Chief Financial Officer. From Astec LifeSciences, we have Mr. Anurag Roy, Chief Executive Officer, and Mr. Saurav Bhala, Chief Financial Officer. We would like to begin the call with brief opening remarks from the management, following which we will have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature and actual results may differ from those expressed or implied. I would now like to invite Mr. Nadir Godrej to make the initial remarks. Over to you, sir.
Good day, everyone. I welcome you all to the earnings call of Astec LifeSciences. I hope you are doing well. The financial year 21-22 was a year of revival for the Indian economy from the COVID-induced disruption. The country made rapid progress in vaccination and closed the year with a majority of the adult population vaccinated with both the doses. India's GDP growth rebounded to an estimated 8.9% in fiscal year 21-22 from the contraction in the previous year. India's merchandise exports reached a record high of $418 billion in fiscal year 21-22, a 40% growth over the previous year. The agriculture and allied sectors have remained resilient throughout the COVID-led disruption, and it is estimated to grow by 3.9% in fiscal year 21-22, as per the latest estimates by the Central Statistical Office. At the same time, the international prices of multiple agricultural commodities, energy and agrochemical inputs have risen sharply during fiscal year 21-22. The significant increase in costs is being driven by supply chain disruptions, a rebound in global demand, and most recently, uncertainties surrounding the Russian-Ukraine conflict. The end product prices for most of our products have also increased significantly during the year, while demand from the export markets continues to remain strong. Now I will take you through the financial performance and key developments of the company during the fourth quarter and the full year ended March 2022. Astec delivered its best ever quarterly as well as annual performance till date. The growth in total income was phenomenal at 60.7% in quarter 4 and 22.1% in the full year 2022 over the corresponding previous period. The top line growth was strongly supported by margin improvement. The consolidated profit after tax grew 79.7% year-on-year in quarter 4 fiscal year 22 and 38.1% for the full year 2022 over the corresponding previous period. Robust top-line performance in quarter 4 fiscal year 22 was driven by higher realizations in export markets and good volume growth in contracted manufacturing business. Exports more than doubled in quarter 4 fiscal year 22, growing by 127.3% year-on-year. The share of domestic business declined during the quarter as we allotted more of the available capacity to fulfill our export commitments. For the full year 2022, the exports business grew by 44.4%, driven by both realizations as well as volume growth. Domestic sales were marginally up by 0.5% over the previous year. The gross profit margin improved to 40% in Q4 fiscal year 22 from 39% in Q4 fiscal year 21. For the full year 2022, the gross profit improvement was substantial at 447 basis points. It was driven by a combination of factors, including product mix, higher sales price realization in some key products, and backward integration benefits. The EBITDA margin for Q4 fiscal year 22 was 26.6% compared to 23.1% in Q4 fiscal year 21. For the full year, EBITDA margin was at 24.3% as compared to 21.5% in the previous year. Improvement in EBITDA margin was slightly constrained due to increase in other expenses on commencement of our new herbicide plant. During the year, Astec commissioned a new herbicide plant and started batch production of CMO products with satisfactory results. The construction of a new state-of-the-art R&D center is on track and is expected to be completed this year. Astec launched 2 new CMO products and a new production process for an enterprise product during the year. For the next year, we will continue to work towards expanding the contract manufacturing business and also focus on diversification into other chemistries. We plan to launch 2 new contract manufacturing products. We are closely monitoring the fallout from the Russia-Ukraine conflict and do not see any significant impact on our performance at this stage. While input raw material prices remain volatile, we expect our margins to sustain in the coming quarters, and we believe that we will be able to successfully achieve our fiscal year 23 profitability targets. The agrochemicals industry in India is expected to maintain double-digit growth in the coming year as well, largely driven by exports. The macro environment for the sector remains conducive for rapid expansion of the sector. At Astec, we believe that we are well placed to capitalize on this opportunity. This concludes our business and financial performance update for the quarter and for the year. With this, I end my opening remarks, and we will be happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. Participants, you may press star and 1 to ask a question. The first question is from the line of Aman Vora from Premier Capital Services. Please go ahead.
Hi, thanks for the opportunity and many congratulations to the management on a great performance. I'd like to let you know, we've been investors in the company for the last 5 years, and when we first invested, the total profit for the full year was about 14-15 crores, and this quarter company has done a profit of 40-45 crores. So extremely proud of the management and the work that you guys have done. I would also like to welcome Mr. Roy to the team. So I had basically 3-4 basic questions. One was on the herbicide plant and the capex we had done. We had expected that it will take us almost 12 to 18 months for the full functioning of the plant to come through. So I just wanted any updates on that and how is the plant functioning now?
Yeah, hello Aman, this is Anurag Roy. Very good afternoon to you and thank you for your kind words. So your question on herbicide plant, As you are aware, we commercialized our herbicide plant last year in June, July. And as we move forward for the herbicide plant in the first year, we are expecting that we would be reaching almost 30% of the utilization. We have a very healthy pipeline of products coming into the herbicide plant, and we expect to take it to almost 90 to 100% utilization in year 3. So as we get on to FY23, we are expecting to take the utilization rates to almost 70%.
Right. Great. And like as we get close to commissioning the R&D center, I think it's planned in Q3 this year. So like now, like could you brief us more on the strategy and what capabilities we are looking to build from the R&D center, and how the management looks at that?
Sure. So see, Astec LifeSciences had come a long way, as you also appreciated earlier. Over the last 5-6 years, there was huge amount of work done in consolidating their existing product portfolio. And as we stand today, the next 5 to 10 years for Astec LifeSciences, we are getting into the growth phase. So in line with that growth phase, our step one would be to put together the new R&D facility, which the management and the teams had planned for the last 2 to 3 years. So that's one of our priorities and focus area, to have that facility up and running by end of this financial year, or as early as September, October this year. So once that R&D center is up and running, we'll be able to, establish our specific technology platforms. We'll be able to put in lot more pipeline products into it, which eventually we could commercialize and can give a big boost to our CDMO business as well as the existing Triazole and enterprise business. So going forward, R&D is a critical piece in our entire growth strategy, and we are very excited to have that commissioned and come on board by end of this year.
Thank you. Aman, I'll request you to come back in the question queue for a follow-up question. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Abhijit Akella from Kotak Securities. Please go ahead.
Yeah, good afternoon, gentlemen. Congratulations on a great quarter, and thanks so much for taking my questions. Just had a couple of clarifications to seek. First one was on a couple of numbers in the results. The other income seems a bit on the higher side this quarter. So just wondering, what might have led to, whether there's any one-off element in that. And also the capex for the full year was a bit on the lower side compared to my expectations. I was expecting maybe closer to, between 150 and 200 crores. So is project execution completely on track, or are we lagging behind in any of the projects?
Yeah, I'll ask Saurabh to address these 2 questions for you.
Sure. Hi, thanks for the question. So on the question number 1 regarding the other income for the current quarter, you're right, there were some exceptional items in the current quarter. First being our insurance claim for the loss of profit due to the March flood got accounted in the current quarter. And also our foreign exchange gain due to our hedging policy was much better in the current quarter. So those 2 were the prime reason of other income looking higher in the current quarter. And reply to your second question, capex, we are exactly going ahead as per the plan, internal plan. There is some slight delay in the R&D because of the change in the scope and other stuff, but overall capex remains as per the plan.
Okay, thank you. So the second one, before I ask the second one, just to clarify, if you could just quantify the one-off items within the other income, that would be helpful. And
insurance claim was about 2 crores, and FX gain was about 3 crores.
Thank you. And the second question I just had was, as we look ahead into fiscal 23, what are the key growth drivers that we envisage here? Obviously, the CRAMS project goes from, say, maybe 30% utilization to maybe 70% next year. But besides that, what other growth drivers do we see for the business overall? And what is the full revenue potential of the herbicide plant that you're envisaging at full utilization? Thank you so much.
Yes, I'll take that question, Abhijit. So as we get into FY23, one, as you rightly talked about, CMO or CDMO business will be one of the key growth drivers. So we are expecting to get 3 or 4 more projects commercialized as we get into FY23. So that definitely will be one of the growth drivers, both on the top line as well as profitability. Second important growth driver would be our herbicide plant. So as all of you are aware, we commissioned it last year, and we are seeing a very good pipeline products getting into the herbicide plant. We also are one of the very few companies in India who have these high potent herbicide facilities, which are really making our pipeline healthy as we look forward. So we are expecting the products at good profitability, good margins coming from our herbicide plant as we stabilize our existing chemistry and the plant, which has been recently commercialized. So that will definitely be part of growth strategy, second pillar of the growth strategy as we get into FY23. And then third key portion would be, looking for the forward. So as we get into this year, there'll be huge amount of focus in building the institutional capability to deliver on the future strategies, growth strategies of Astec. So we'll be preparing for that. We'll be laying the capexes groundwork so that we look forward for the future growth of Astec. So these will be the 2-3 key initiatives which we are expecting in FY23. The growth being led by herbicide plant utilization, the CMO products, and lastly but not the least, we'll also continue to work on strategic sourcing, efficiencies in the plant, so that we try to maintain our margins on the existing enterprise business as well, despite the volatility and macro factors in the market. So those would be the 3-4 points I would like to highlight to your questions.
Thank you so much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Ishmit Arora from SOIC Ventures LLP. Please go ahead.
Hi, congratulations for a great set of numbers, sir. My question was, what is our percentage dependence on China for raw material? Because I think we've done a lot of backward integration projects in last 1 or 2 years.
So if you look at our total revenues and amount of spend on raw materials, key starting materials coming in from China, we roughly stand at 65 to 67%. And for some of the key starting materials or some of the key intermediates for our AIs, we are more or less 80 to 90% backward integrated. So we continuously evaluate the make versus buy decision as we deal with the supply chain disruptions and some of the shifts in the macro, and hence have the overall control on the product life cycle as well as the value chain. So to answer your question, yes, we have around 65% reliance on import from the China products, but we have de-risked that by developing some of the vendors in India and other parts of the world. That's number one. And also by systematically backward integrating so that we can do the make versus buy decision as and when required.
Right. And sir, next question was a bit medium term in nature. So when we look at your peers like PI Industries or something like a Deccan LifeSciences, like both these companies are really large when it comes to the top line, almost 1,000 crore CRAMS run rate. So what are our aspirations when it comes to next 3 to 5 years, and what is our capex outlook to accelerate the growth aspirations?
So I feel, and the entire team at Astec feel that we are, very well positioned right now to drive the future growth. A lot of macros, as most of you are aware, are also supporting the growth for the chemical as well as pharma industry. So we really want to embark on that journey. In terms of, 3 or 4 things which we will be heavily focusing on is, number one would be the R&D. We really want to build future Astec, which is defined based on our research, technology and development solutions to our clients. That would be the key pillar which we are putting in place by end of this year. Then second important piece would be our ability to tech transfer what we build in the R&D and how well we can commercialize it for our partners. And that will be the key other pillar which we are establishing within the organization. And that will be our strategy for the next 2 to 3 years. For that, we would also not hesitate to go heavy on the capex. For example, in the coming year, FY23, we have committed almost 350 to 400 crore capex, and depending on how we proceed over the next 2 to 3 years, we'll continue to invest depending on the pipeline generation and the R&D capability which we'll be building in the near short term. So in the medium term, our strategy would be to scale up our CMO business, heavily invest on building the pipelines, drive growth through R&D, and building relationships with some of the innovator partners of the world.
Thank you so much, sir, and all the best.
Thanks.
Thank you. The next question is from the line of Saurabh from Asian Market Securities. Please go ahead.
Thank you for the opportunity. So if you can give more details about the FY23 capex, you mentioned about 350 to 400. So where it will be spent, and more details on the fungicide plants which we highlighted in the Q2 call.
So, okay, to answer your first question on the capex, 350 to 400 crores, I believe Saurabh earlier mentioned, the R&D capex, which was expected to fully realize last year. Some of it is getting into this year. So in that 350, 400 crores, we estimate roughly 110 to 120 crores as against the R&D center capex. Then, as I was mentioning earlier, we are also expecting very good pipeline products for our existing herbicide plant. So as our goal would be to fully utilize the existing herbicide plant, we will also concurrently start investing for further expansion of the facility, for which we have committed 35 to 50 crores. Then the balance, 70 to 80 crores, we have kept it for a lot of improvement, safety, compliances, activities at our Mahad locations. Just to give you 2 examples, we are planning to further digitize our facilities, manufacturing facilities at Mahad, to bring them to the innovator or the global standards level. We are also kicking off one of the safety initiatives with DuPont Sustainable Solutions, so that we become best in class on the process safety side. So we are also investing heavily to, further take our competencies to the global levels, and for that we are committing almost 70-80 crores capex. And finally, as a part of our growth strategy, we have earmarked almost 150 crore for greenfield multi-purpose plant, which will obviously take 3 to 4 years to commercialize, but we'll start laying the foundation in FY23 from the capex perspective. So that's the broad breakup of the capex, what you were asking. And yeah, second question, I missed out on the second question. Can you repeat that again, please?
Yeah, so in the Q2 call, there was a mention of the fungicide plant. So if you can provide more details, is it the fungicide plant and the MPP plant is the same?
So I think I answered that we have earmarked roughly 150 crores for the multipurpose plant, and there we would have, the mix of fungicide products and some of the other intermediates.
Okay. And so my second question, if you can provide the breakup of CMO revenue and enterprise revenue for Q4 and FY22, and also how we should look at the growth, at least in terms of the CMO revenue. Like you mentioned, there will be recent growth in next year. So what kind of a growth we should expect, and also on the margin. So the earlier guidance of gross margins of 40%. So should we assume the similar margins, or with the mix changing, the margin should improve?
Participants, please stay connected. Line for the management dropped. Participants, please stay connected while we rejoin the management back to the call. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. Saurav, may I request you to repeat your question once again for the management team?
Yeah, sure. So if you can provide the breakup of revenue of CMO and enterprise for FY22 and Q4, and also your gross margin guidance. Earlier guidance was 40%. Now with the CMO mix going up, should we see it going for 40% plus?
So for Q4, our revenues from the CMO business was roughly 23%. For the full financial year, our contribution in revenues from the CMO business was close to 13%. So that's for the existing financial year. As we move forward and as the share of CMO business grows in the overall revenue, clearly there will be some basis point increase in the margin. Roughly, as a rule of thumb, enterprise plus 5 to 7% is what we see as the CMO increase in margins. So as and when we see the percentage share of the CMO business going up, accordingly in the range of 5 to 7%, the margin keeps going up.
Okay. Thank you for your.
Thank you. The next question is from the line of Rohan Gupta from Edelweiss Financial Service. Please go ahead.
Yeah, hi sir. Good evening and congratulations on the set of numbers. So just a couple of clarifications.
Ron, sorry to interrupt you. Your voice is not very clear. May I request you to speak through the handset?
Yes, please.
Sure.
Is it clear now?
Yes, thank you.
Yeah. Sir, I was asking that a couple of clarifications. First is if on our herbicide plant on the full utilization, what can be the revenue potential from that plant, if you can give some numbers on that?
Yes. So as I was mentioning, 2 to 3 years time frame is when we are seeing full utilization of that particular plant. And we are looking at asset turn of 1.5 to 1.7 from that particular plant. So, anywhere from 230 to 270 crores is the revenue which we are targeting to come at full utilization.
And so you just mentioned that this current year in FY23, you are planning to put another capex on this plant only of 50 to 70 crore rupees. So that will also drive the incremental revenue in the same ratio of 1.3 to 1.5x, or one can expect because of the better utilization and operating leverage, the revenue potential can be higher.
So I mentioned 35 to 50 crore commitment for the plant capacity expansion, and again you could take 2 to 3 years for full utilization for the new capacity, and accordingly, obviously, there'll be some uptick in the revenues from this new herbicide investments as well.
Okay. Sir, coming coming on CDMO, where this quarter was exit run rate close to 22 to 23% of revenues, our full year was close to 13 to 14%. In terms of, given the current product pipeline in CDMO business, where you see that the revenue contribution from CDMO in next 2 to 3 years in terms of overall top line?
See, over the next 2 to 3 years, one of the bottleneck was obviously further expansion in the R&D capabilities. So now with new R&D facilities coming up, we could do a lot more development, which means we could take a lot more pipeline products for our CDMO business. And what we expect is, we want to initially in the near short term take revenues to at least 25% level, 25 to 30% level for the CDMO business. And then beyond that, it all depends how well we handle the customer relationships, how we see the pipeline flow coming from the R&D, the complexity of the molecules of the products. So there are a lot of variables, but our goal would be to at least take those numbers to 25-30% over the next 2 to 3 years.
Sir, on our existing capacity, definitely we see the current year herbicide business utilization may go from 30-35% to 70%. Where other plants are standing in terms of capacity utilization, in FY22?
So I think in the previous calls also there have been some guidance given on the capacity utilizations, and we are almost at capacities for our plants. So every year the delta capacities are built up either through manufacturing efficiencies or debottlenecking. And most of our plants, as you shall appreciate, are multi-purpose plants. So getting to a firm utilization rate is not at all possible because there are complexities of number of steps which you put in those plants with the new products coming in. There are other variables of scale up, the complexity around the chemistry. So getting to the utilization numbers numerically becomes very challenging. But what we keep doing year on year is we keep taking initiatives to debottleneck. We keep taking initiatives to reduce the number of steps, number of, treat our effluents properly, less use of solvents, so that we continue to increase our capacities and hence, the revenues from the existing plant.
Fine, Minister. I get that. So would it be fair to put a asset turn of 1.3 to 1.5x on your entire FY23 capex plan of 350 crore around? So
yes, that would be fair.
Over next 2-3 years.
Over next 2-3 years, sir.
On full utilization. I get that, sir. So just last from my side, in your opening remarks, you also mentioned that apart from agrochemicals, you are also looking to some other industries and getting queries and probably working on that. Can you just give us some more, can talk a little bit more on that where we are in and what industries we are getting into and user industries, and where you see that the revenues going from non-agrochemicals in next 3 to 5 years timeline?
Yeah. So I don't recall saying other industries. Obviously, we are seeing a lot of good opportunities in the other industry, but as we feel internally that we have not even reached our potential in our core, which is agrochemical. So in short to, in near to short term, we'll be heavily focusing on working on our existing chemistries and platforms catering to the agro business. And then opportunistically, we'll look for expansion into some of the other sectors, could be specialty, pharma intermediates, so on and so forth. But as of now, we are building strategies on building, capabilities, platforms around agrochemicals.
Okay. So thank you very much for the clarification. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Veena Patel from Nartam Seksaria family. Please go ahead.
Good evening. Hello, am I audible?
Yes. Yes, ma'am.
Can you please quantify the contributor from the new herbicide plant in the last financial year, FY22?
So, from the herbicide plant, it was close to 25 crores.
No, sorry to interrupt you. Veena, may I request you to mute your line from your side, please? Thank you. So you,
Second question.
Yeah, did you hear my answer, or I can repeat my answer? So the revenues from the new herbicide plant, since it was running only for 5 months or so, it was close to 25 crores.
What is in the quarter 4? What was that number? And for the full year of FY20, what was the volume growth?
70%. You're not audible.
Veena, may I request you to speak through the handset, please?
Yeah, I'm audible now.
This is 25% utilization around that.
Hello, Veena.
Yeah, can you hear me?
To make that clear.
Veena, sorry, the audio is not very clear. May I request you to come back in the question queue?
Yeah.
Thank you.
Yeah.
The next question is from the line of Rohan Gupta from Edelweiss Financial Service. Please go ahead.
No, my question has already been answered.
Thank you. The next question is from the line of Prateek Shah from Denora Wealth Private Limited. Please go ahead.
Good afternoon, everyone. So my question is basically on triazole fungicide. So what is current contribution from triazole fungicide coming, and what is the diversification plan there? So we are about to launch few products in the same category. And I guess few quarters ago, there was some overcapacity coming in from China. So there was some price. So we are facing some price issues over there. So what is current situation?
First and foremost, we operate in a multi-purpose plant, multiple products. Obviously, triazole chemistry is what we deal for the most part. But we normally don't give out any individual molecule or platform-based, the margin indication. So that's one. On the overall triazole chemistry space, at an overall level, actually what we are seeing over the next 5 to 10 years, we are still seeing 3 to 4% growth rate in this particular segment. And last year, for some of the molecules, we had actually also seen some of the supply shortages because of the supply chain disruptions in China and some of the input cost increases and the energy crisis. So from that perspective, the triazole chemistry continue to offer us opportunities. And the best part about Astec LifeSciences is over the years, over the last decade or so, we have got a firm grasp on the technology aspects on this particular platform. And hence, we are globally extremely competitive, and we maintain our strong position despite the challenges from oversupply and any kind of supply demand balances in the market.
Okay. And second question would be, is there any plan for merger with Godrej Agrovet?
I'll take that. All right.
Yeah, please, Mr.
Yeah, I'll take that. So we were planning a merger a few years ago, because when we acquired this company, we realized that it can really grow big, and but it would require big capex. And that time the balance sheet was very small, and we thought that the capex, it will not be a capex it needs. And you have heard the numbers we are talking about.
Sure.
And now we believe that the balance sheet is strong, the performance of the company is very good, and the kind of capex appetite we have, for next few years can be managed on the balance sheet of Astec LifeSciences. So as of now, we don't have any plans to merge it unless and until there is a big acquisition or M&A opportunity which can really change the game. So I think as far as the current plan is concerned and the capex which is planned in next 3 to 5 years, I don't think it needs any support from Godrej Agrovet Limited or merger into Godrej Agrovet Limited.
Sure. Thank you. And the last clarification I wanted, you were saying that the percentage increase in CMO business will help improve our gross margins by say 5 to 7%. Am I correct?
Yeah, that's a broad level guidance which we see, and obviously, it could go up or it could be lower, but that's what we have typically seen, 5 to 7% more than the established or the enterprise product.
Okay, great. Thank you so much.
Thank you.
Thank you. The next question is from the line of Mithun from Kiva Advisors LLP. Please go ahead.
Hello. Question is on what will be capex in FY22, and wanted to understand that the growth that you're getting in the last quarter and in Q3, was this driven primarily because of price increases because of the disruptions in China? And do you see FY23 as China normalizes, even your pricing will normalize and margins will come back down? Or do you see this sustaining at the Q4 levels in FY23?
Q3 and Q4 results were clearly impacted by the disruption in the supply chain and the crisis in China, which obviously led to escalation of prices on the finished product. But couple of things from the business decision perspective which went really well was some of the strategic sourcing which we did at the right time, which gave us fair differentiation over the competitors in terms of preserving our margins despite the volatility in the market. And second thing which I was talking about earlier, continuous improvement, manufacturing efficiencies also helped us. So those were the two business side inputs that came in for good profitability. Obviously, we were also successful in passing on the price increases to our customers based on our existing relations in the global markets as well as domestic market. So that's how we go Q3 and 4. To answer your question, how things will pan out in future, as the volatility subsides, obviously some of the input raw material prices are likely to come down, which will also mean that the prices on the finished products may come down. But overall, our goal and the way we want to drive the business is we want to maintain almost similar margins as we move forward. There are some fundamental changes which might come as we get into FY23, which could have negative impact on our margins. For example, one of the Zoll's products in European markets may go off this year. If that announcement goes through, there'll be oversupply situation and hence the pressure on prices. So we are constantly monitoring those macro situations, but overall we expect to maintain more or less similar margins as we get into FY23.
Right. And just one last question. I wanted to understand because of political situations and companies trying to move away their supply chain from China. I just wanted to understand how much of that are you seeing as a benefit which is structured in nature and which could actually grow significantly from now?
The China plus one strategy and our government promoting more of in-house building of capabilities for the country. All these are driver industry. We want to continue to leverage on that. A lot of growth for our CMO, CDMO business will come from this particular trend. And we are seeing that coming from our customers as well, wherein they are looking for the second source of supply. And that's how we are also building our future pipeline.
Great, thanks.
Thank you. Next question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yes, sir. My question is with respect to the 500 basis point gross margin expansion that we see this year. So if I recall, a year back, we had a pricing pressure on one of the trizols. So is it that that pricing pressure has eased and we are seeing the margin expansion flowing through? And how much would be the CMO mix change that you would have experienced in FY22?
So clearly, those growth margins or profitability increase has the pricing has a huge contribution there. But as all of you or you would appreciate that there's huge amount of volatility in this product portfolio which we currently have, and that's why it becomes increasingly imperative or important for us to continue, de-risk, expand our portfolio products and get into the CMO business. And that's what we are precisely doing it. There'll be some quarters wherein you would see less margins. There'll be some quarters like the last two wherein the margins will be on the higher side. So from driving the business perspective, I think what we need to focus on, and which I mentioned earlier, it would be on strategic sourcing. It would be continued to work on manufacturing efficiencies, vertical integration or backward integration. So those are the things from business side we are working on, and rest we play the volatility in the market to best of business decisions.
And how much will be the mix change? The CMO, which you said is 13% of business in 22. How much it would be last year?
So last year we were at roughly 17%, and this year we have gone a little bit down. We are close to 13%. But as I was highlighting earlier, over the next 3 years or so, we expect it to get to 25% or 30% levels.
Okay. So it's fair to comprehend that bulk of the margin expansion is because of the enterprise exports and because of the triazole price. Is it a fair assumption?
Yes, you could say that.
Okay. My last... Sorry, sir. Go ahead, sir. Sorry.
Yeah, at least for the current financial year, right.
And when we are saying that the CMO will rise in mix, is that the herbicide plant utilization which brings the CMO improvement? Because that's where the products on CMO will come, or is that interpretation correct?
Yeah, so herbicide, we are seeing a good pipeline of projects coming in, the CMO projects coming in. So that's clearly one of the drivers. And then we also have other fungicide CMO products, which we typically put in our multipurpose plants. So there also we are seeing a lot of good opportunities come in. So I would say it's a mix of both herbicide and fungicide projects to drive the growth.
So the asset available to you in the near term, where you have to take up the utilization, let's say in 23, is basically the herbicide plant. And then the asset available to you, which will bring in further growth, will be the greenfield multipurpose plant of 150 crore whenever it comes up. Is that correct, sir?
Right. And plus, I was talking about the herbicide expansion, which we have been talking about, and then obviously the debottlenecking on the existing multipurpose plant.
Can you tell the years when the herbicide incremental expansion will come operational, and when will the debottlenecking become operational?
So
is it 24?
It's an ongoing exercise. We have already taken up the debottlenecking projects as we get into FY23, so that will be kicked off for the current financial year. For the herbicide expansion, over the next couple of quarters, we'll start the investment to expand further. So that should also likely to kick off over the next year or so. I would say over the year, and that will go through the similar cycle as I was mentioning, 30, 70, 100% utilization over the next year.
Okay. Thank you very much, sir. Thank you.
Thank you.
Thank you.
Sir, Pritika Kapil Kapa.
Next question is from the line of Aman Vora from Premier Capital Service. Please go ahead.
Hi. Thanks for the opportunity again. A couple of questions. One was like on the like you said to the last participant that enterprise business was a large contributor to this year's outperformance. So I understand that the market dynamics decide the pricing for the molecules, but do we have any pricing power in those, or like, because it is very difficult to predict how the pricing of those molecules will move. So anything on the pricing power if we have any?
And I keep going back to the point which I was mentioning. One is obviously the relationships you have with some of the key customers. So there also we have, the deep relationship with the customer, wherein in these volatile markets, there are times when we support the customers and vice versa. So that's one thing. But two critical pieces which are very important to drive this kind of volatile businesses, taking the right business decisions around strategic sourcing and continuously working on life cycle of the product as well as manufacturing efficiencies. So there will be quarters wherein we might be taking 8 out of 10 calls right on strategic sourcing, and we'll have good profitability. There could be a scenario wherein the calls don't go as we expect, and that will impact the margin. So I think that's the only way to drive this particular business. So I keep giving the guidance to my teams and business that we should continue to focus on our fundamentals of working on manufacturing efficiencies, strategic sourcing, and the third piece is, the continuous improvement piece.
Right. And just one last question. So if I'm not wrong, we spent about 250 to 270 crores on the R&D facility in all, including the one that we'd be doing this year. So I just want to understand from you what kind of capabilities we are building there, and in comparison to what the industry already has, and some color on what we are building there after this capex that we've done and that what we've been doing now.
First of all, a little bit of check on the numbers which you have. For R&D, we have invested, or we are investing around 120 crores, and historically we would have invested roughly 20 to 30 crores in the past for the R&D capability for Astec which we have. So roughly you are looking at 120 to 150 crores. This 100 crore plus investment in the new R&D came with a vision that we want to build Astec for future. And as I was mentioning earlier, the technology and the research will be at the forefront of Astec growth. And, with that premise or with that fundamentals, we are taking this huge investment in R&D, and I can proudly say that we would be, among the few companies in India heavily investing on R&D, at least in this particular sector. And we want to provide full service technical scale-up solutions, process safety, kilo labs to the innovators as well as enterprise companies of the world. So with that goal, we have committed on this particular R&D investment.
Right. Thanks a lot.
Thank you. Next question is from Dhruv Muchal from HDFC Asset Management. Please go ahead.
Yeah, sir. Thank you so much. In the previous call, you mentioned that the CapEx for the CMO plant was about 110 crores, and the turn is about 1.5, 1.7x, which gave us a revenue of about 170 crores at full potential. But this time you mentioned about 230, 270 crores at full potential. So what am I missing, sir?
So, one, obviously, for our CapExes, our earlier projections was 110, 120 crores. Those projections went up because of the input price increases on steel and, other raw materials for the CapExes. So that's one. But having said that, as I was mentioning earlier, we are seeing a healthy pipeline of herbicide products coming into this particular plant. We are the only company who also have a setup for high potent facility, which is also been of a good interest to some of the innovators and CMO players. And with that, we could guide the business to some extent, choose some of the molecules we want to pick in those herbicide plants. And we can now confidently say that, we could get 1.5 to 1.7 asset turn from that facility, which is equivalent to, 230 to 270 crores. And obviously, when I say 1.5, 1.7, it's on the final year, not on the first year, the asset turn, which we aim to, get from this herbicide plant.
So just to reconfirm, when we say 230 to 70 crores, 1.5, 1.7x, and the full potential of 230 to 70, does it include the 35 to 50 crores of expansion that you're planning in the herbicide plant, or this is before that?
No, that doesn't include that. So that the decision to further expand obviously is coming from the good outlook of the pipeline and the good asset turn which we are getting from the existing herbicide, and that's what is the motivation to set up the new herbicide plant.
Got it. So versus the earlier expectation of asset potential, it is much better because of the improvement in the product profile that you see now.
Yes.
Okay. Got it. Thank you so much for that.
Thank you.
Thank you. The next question is from the line of Rahul Paliwal from Schaefer Family Office. Please go ahead.
Thanks for giving clarity on the merger decisions of Astec with Agrotech and the thought process behind it. This is really appreciated, sir, and I'm sure this will prove value accretive for all stakeholders going forward. Sir, another suggestion we have is why not rebrand Astec as a lean focused CDMO CMO entity named as Godrej Green Chemical or Godrej Advanced Science or likewise. That's one suggestion, and we need your inputs on that. And question number 2 is any plan to get into a biochemical or biologics or fermentation use case side?
So, thank you very much for your appreciation. I think the purpose of the merger, as I said, was to give this business an opportunity to grow exponentially. And I think we have demonstrated that without doing that, and the balance sheet can support further expansion and the plans Astec LifeSciences has. I think your suggestion for rebranding is under consideration because I think Astec LifeSciences with more than 65% businesses, exports and registrations, etc. are in the name of Astec LifeSciences. So we have been receiving your suggestion and been studying that, and very soon we will take a decision either way on that. On biological, etc., I think I must tell you one thing is that the field of chemicals is huge, and we just have to choose where we play because we want to be very focused, and we have a plan not just for next 3 years but next 5 years where substantial capex has been budgeted. We would like to chase that plan to perfection. As Mr. Anurag has already said that we will focus on the agrochemical opportunity for next 3 to 5 years because there is a huge scope exists, and we have demonstrated that we can capitalize some of that opportunity very well. Regarding biological, yes, this is an opportunity. It is under discussion, but we have not decided as yet on when to embark on this.
Thank you so much, sir, and welcome to on board, Mr. Anurag.
Thank you. Thanks so much.
Thank you very much. Ladies and gentlemen, we'll take that as our last question. And I'll hand the conference over to Mr. Nadir Godrej for closing comments.
Thank you. I hope we have been able to answer all your questions. If you have any further questions or would like to know more about the company, we would be happy to be of assistance. Stay safe and stay healthy. Thank you once again for taking the time to join us on this call.
Thank you very much. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thank you.